If you were an investor and you looked at what happened in the first half of the year, what happened to your retirement, what happened to your investments, it's a pretty depressing picture. Not only have you lost a significant amount of money on your equities, but your bonds that are supposed to be your risk mitigators, they also got hit really hard. So you've had massive problems of returns, significantly negative. Your correlations, your risk mitigation did not work at all. And it's been a pretty volatile. So it's understandable that when people looked at their first half statements, they got quite upset. So I look at the components of headline inflation, and in particular, what's been driving it higher in recent times. And what we have right now is energy and food in particular are going to be much weaker drivers of inflation. So the headline number is going to come down, but worrisomely, the core number is going to stay stubbornly high and speaks to an inflation process that has become more entrenched and has become more broad-based in our economy. It will come down by the end of the year. It will be sticky. I'm looking for a core CPI in the 4.5% to 5.5% range, so well above the 2% target of the Fed. But what I'm most worried about is the collateral damage that's going to be associated with inflation coming down because the Fed has been so late in responding. So they started getting it wrong 15 months ago when they absolutely embraced the notion of transitory when it was an open question. Had they listened to companies, they would have been much more humble in saying we don't quite understand the inflation dynamics, because companies themselves were warning that the supply disruptions they were seeing, and we know the list, supply chains, container ships, what companies were seeing, what they were warning, saying we're not sure they're going to resolve themselves quickly. And yet the Fed got hooked on this notion it's transitory. And then it got itself into a cognitive trap. It kept on repeating it and repeating it and repeating it all the way, as you know, till the very last day of November, by which time it was clear that inflation was a problem. And then retired it, but didn't move. It could have done more at that stage. And you ended up with this absurd situation that in March, it was still pumping in liquidity. It was still doing QE in March when the inflation rate measuring for February with a month lag was already at a 7% handle. So it is bad analysis, bad forecast, too little, too late, and miscommunication. And that's how we've ended up in this mess. So we have two big dynamics going on. One is on the demand supply. We've gone from a world of deficient aggregate demand to a world of deficient aggregate supply. That's going to resolve itself. But we have another phenomenon going on, which is the nature of globalization is changing. And we are going from a very intense focus on efficiency, on just in time, to another focus on resilience, just in case. And that transition is by its nature inflationary. And that hasn't played out fully yet. That's why it was really important to ensure that the inflation dynamics don't develop very deep roots across many, many segments of our economy. Otherwise, we may end up with a low growth, high inflation environment for much longer than we need to. I think central banks play a very important role. The reason why I'm so critical is because central banks have an enormous responsibility and they're given enormous power. Where else do you have an institution that is so powerful and can make decisions on its own, has political autonomy? And that is an incredible thing to have. And that comes with a lot of responsibility. So you have to be held accountable to your actions. And I think central banks are absolutely key, and politically independent central banks are essential for economic well-being. So I am not in the camp of central banks, something we shouldn't have and everything else. No, we absolutely need them, but we need them to function well. And we need them to be honest. When they make a mistake, tell us why you've made a mistake and tell us what you've done in order not to repeat the mistake. When the Fed publishes its quarterly projections, people call it laughable. And who calls it laughable? Former Fed officials. They also complain. And we need to get back to a world where the Federal Reserve is credible, because that is absolutely essential to the well-being of our society. The problem is that, talk about cognitive trap, we've all gotten used to measuring things by GDP, and we're having a huge problem getting out of that. So my definition of a recession is a holistic definition. It goes well beyond 2 quarters of negative GDP. We are not yet in a recession. We're not. The labor market is too strong. Consumer spending is too strong. Business balance sheets are too strong. We simply are not in a recession. Is the risk of a recession high? Yes, it is high and getting higher. Why? 1, the Fed is hiking into a slowing economy. 2, as the IMF forecast showed us recently, all the major areas of the global economy are slowing. They're called the gloomy and uncertain. These are strong words coming from the IMF. I was there 15 years. I know you don't use the word gloomy lightly. So we do have a high risk of recession. It's not preordained. There are and should be various measures to be taken in 4 areas in particular to stop us from slipping into recession, but let's monitor it. The risk is certainly high. So first and foremost, we got to get control of the inflation beast. And that is a Fed that needs to act in not only tightening its monetary policy, but also regaining credibility. Its forward guidance right now is almost meaningless. And that's not a good thing. It's a major tool of monetary policy. So the Fed has a lot to do on the inflation front. Second, we need to target fiscal policy more to protect the most vulnerable segments of our society. That has massive economic, social, and political consequences. Third, there's a whole host of pro-growth, pro-productivity reforms that need to be done, including to increase labor force participation, to improve the supply chains. They have a domestic angle and they have an international angle. And then finally, let's not forget financial stability. Let's not forget how risk has not only morphed and migrated from banks to non-banks, but non-banks have been encouraged by years of zero interest rates and massive and predictable liquidity injections to go well beyond their native habitat in taking risk. So the non-banking sector is still offside, and we have to keep an eye on the financial stability risk because that could come back and harm the economy. They don't have an immediate effect, but they are important. They basically come down to facilitating the supply side. We've gone from a world of deficient aggregate demand to deficient aggregate supply. And we see it everywhere. You need only go out and you'll see what labor shortages look like. You'll see what supply chain disruptions look like. On the labor side, it is critical that we take steps to enhance labor force participation. That comes down to basic issues like childcare. That's really important. Female labor force participation hasn't recovered to the levels where it should be. We can do more on supply chains. There is a massive set of opportunities for public-private partnership. We should learn from the good things that happened during the pandemic in terms of how private-public partnerships can work really well. And then finally, let's not forget that that's an international problem. It's not just a national. So collective action becomes really important. Having said that, if you look forward, there are some silver linings. I don't want to in any way understate the losses because they are painful, but the silver linings. One is because valuations are becoming more reasonable, we're starting to see entry points for really attractive long-term investment. They are selective, they are individual rather than general, so they're not buying the index, but they're buying certain names that have been contaminated much more than they should given their fundamentals. So there's value being created. We also finally are seeing bonds return to their traditional role of risk mitigation. Why? Because interest rate risk, inflation risk has played out, and now we're looking at recession risk. And then third, something that we don't think about, we came this close to having a third risk factor. And as you can see, I really like thinking in terms of risk factor rather than asset classes. A third risk factor come together with the other two, which is inflation risk and recession risk, and that is market functioning risk. There were periods where we saw liquidity really strained, and the good news is the markets held, and we were able to navigate through the repositioning that people wanted to do. We've weaponized the international payment system, and we've weaponized the international payment system without any set of standards, safeguards, or anything else. And if you are in a third country looking at that, you're going to start asking yourself questions as to your vulnerability to a dollar-based system. And if we're not careful, we end up fragmenting the global economy. Russia is a G20 member. Russia is the 11th largest economy, or was the 11th largest economy in the world on the eve of its illegal invasion of Ukraine. And the notion that you would put sanctions on its central bank, the notion that you would take it out of the payment system and wouldn't allow it to settle through the payment system was one that was almost unthinkable. That is the nuclear weapon of sanctions. Trade sanctions, sanctions on individuals, this is something we know. And you know what? There is a system that governs the trading sanctions, etc. But this was something really different. It's very powerful if you don't have carve-outs. You can bring an economy to its knees. I mean, imagine that I suddenly stop you from using any credit card, debit card you have, and all you have is a bit of cash, and I tell people you can't accept Andy's cash anymore. No matter what you want to do in terms of paying or receiving, you won't be able to do it. That's how powerful sanctions of the payment system is. So we've weaponized a really powerful tool without having the safeguards that come with weaponizing a really powerful tool. Take it seriously. The global financial crisis, inflation. I wrote a book, as you know, in 2016, The Only Game in Town, that looked at what would happen if we continued to rely on central banks, and central banks were forced to stay out of their well-defined area of operation for such a long time. So it's that sort of thing. And of course, it was Argentina's default, which I couldn't understand in 1999 and 2000, why people were continuing to allocate so much money to a default that I thought was almost preordained because of policy failures.